My name is Isaac Boltanski. I run financial policy research for a small broker-dealer in Georgetown. And so I have followed the NYDFS since it was created, and like everyone in this room, is interested in hearing what our next speaker will say. Look, we have heard all day long that the world of online lending is rapidly evolving. We have seen in real time as technologies have improved and new firms have entered the market, and many consumers have benefited as a result. Even with those structural tailwinds, though, there are still questions facing this industry. As we heard earlier today, there are a multitude of structures and strategies in this space, which gives rise to what I think is a broad set of contrasting themes. Bank versus non-bank, charter versus partner, innovation versus incumbency, and of course, state versus federal. In that vein, the great value of an event like this one is to bring together various stakeholders, policymakers, industry, consumer groups, into the same windowless ballroom in order to consider what are, at their core, fascinating questions. Luckily, one of the key policymakers in this space is here with us today. Maria Vullo has a deep background in the Empire State. She was confirmed by the New York State Senate as Superintendent of Financial Services in June 2016. Prior to joining NYDFS, Ms. Vullo was a litigation partner at Paul Weiss and served as Executive Deputy AG for the Economic Justice Division in the Office of the New York State Attorney General. That is a heck of a title. She is also an accomplished trial lawyer, having argued before the U.S. Supreme Court and numerous other jurisdictions. In her current role as superintendent, she is responsible for protecting consumers and markets in New York State from fraud and financial crises. From that position, Superintendent Vullo has been at the forefront of fintech policy. And she's helped shape core elements of the things that we've talked about all day so far. On the one hand, Superintendent Vullo opposes the regulatory sandbox, which has been an area of discussion all day, and has actually filed suit against the OCC's FinTech Charter. At the same time, Superintendent Vullo has guided the NYDFS through the formulation of important state-level policies impacting FinTech, from online lending all the way to cryptocurrency. And so given the inherent complexity of the issues at hand, from financials to federalism, we are lucky to hear from our next speaker. Without further ado, please welcome New York Department of Financial Services Superintendent Maria Vullo.
I didn't realize there'd be some music. Well, thank you. And I see that I have to keep that time watch, and I'll do my best. I'll certainly do that. But thank you, Isaac, for that introduction. And I have to also thank Phil Goldfeder and also Cornelius Hurley and everyone here on the Online Lending Policy Institute for convening this terrific conference. Before I get to the text of my speech, I loved Isaac's sort of contrasts, although I find standing in Washington, D.C. today, innovation versus incumbency. Maybe we need to get rid of incumbency. But I think we can do that and still be very innovative. So anyway, I love that contrast here. So, I mean, this is a terrific program that you all have. It's very timely, and despite what's going on in Washington, D.C., and all the divisiveness that we're experiencing in our nation's capital, I think that dialogue among all the various stakeholders is critically important, and I think we've done a fair amount of that in New York. Certainly, you probably have some expectations of some things I'm going to say in this speech, and I hope to fulfill those expectations. Yes, I do believe that toddlers play in the sandbox. That was my phrase, and that adults play by the rules, and I'll get to that a little bit. As many of you know, so my agency, the New York State Department of Financial Services, we issued an online lending report this past summer, and I'll discuss some of those topics. Before I get into that, I wanted to introduce Sharon Amami, who's my Executive Deputy Superintendent for Banking. She leads the banking division at DFS, and at DFS we have under my plate, I'm both the banking commissioner and the insurance commissioner, so I have a fair amount of experience on state-based regulation. When I hear people talk about patchwork quilt and how, what's going on in the states with fintech now is somehow unusual. It's like the insurance industry is a state-based industry. I regulate insurance industry, and there's 50 states, and the Washington, D.C., and Guam, and the Virgin Islands, and it's a state-based industry. And when you're talking about setting of national standards with respect to, for example, the OCC FinTech Charter, I challenge people to think about the Affordable Care Act, also known as Obamacare, and health insurance. And there are people that say, no, we shouldn't have national standards for health insurance. We shouldn't provide everybody with comprehensive health insurance. We should leave it to the states to sell what I call junk insurance. But in this banking fintech area, no, we need to have national standards. So I really question, I think you have to look at the particular issue and who's driving it, because it is not the case that state-based regulation is an unusual thing. In fact, it's been around since the beginning of time, certainly in the insurance space and also in the banking area with respect to non-depositories. Let me also say something else. I love Washington, D.C., and I'm also a big Mets fan, and the New York Mets are my team. I was really glad to see the Yankees get really beat badly last night, and I'm really glad that the Washington Nationals are not in the playoffs either. But I have to say I'm also a student, not of baseball, but of history, and I would note, I don't know if anybody knows this, but the tradition of the seventh inning stretch actually began here in Washington, D.C., and it began with President William Howard Taft, who also became a Chief Justice of the United States Supreme Court. But it began when he was attending the opening day game of what was then the Washington Senators, which frankly was a pretty good title of a team. During the seventh inning, he was a large man. He stood up and he stretched his legs, and the crowd thought he was leaving, stood up in respect, and that's how the seventh inning stretch occurred. That's a true story. So I think we're now in the seventh inning stretch of the 2018 election cycle, with much on the horizon, and I won't speak any more about that. But I will say, again, that Washington, D.C. right now is a very challenging place, and I think we see a lot with what has happened with the Supreme Court, with the tax bill, with trade tariffs, and I would say with a deregulatory agenda that is just coining a phrase. It's as if all regulation is bad, which is just not the case. And I think we need to not continue with a collective amnesia about that. Let's stop talking about terms. Innovation, fintech, deregulation. And instead, let's talk about what the actual issues are, and I think that's why conferences like this and a dialogue is important. It's also important to recognize that, and I'm sure everybody here knows, we are now in the 10th anniversary of the worst economic crisis since the Great Depression. And I think we all know, let's not have amnesia, that one of the root causes of the Great Recession was the laissez-faire regulation of large national banks, along with limited regulation of non-depository financial institutions engaged in mortgage lending. That's just a fact. And 10 years later, we see an economic boom that's benefiting the wealthy and not reaching many lower and middle-income Americans. And some have not learned anything from the financial crisis, it seems. And one of the key reforms was the Consumer Financial Protection Bureau, which is being dismantled day after day. One of the most recent efforts is in the student loan debt area, which is one of our largest, loan debts in the country, is student loan debt, and we really need to be paying some attention to that. And in this area, with the CFPB deregulating itself or dismantling itself once again, and members of the panel before me referenced this, it's up to the states to fill in the void. Again, though divisiveness seems to be the name of the game in Washington these days, I'm actually very happy to discuss these topics and to seek consensus solutions. Given the scope of my role as regulator in New York, I think it's very important to engage in dialogue with all the stakeholders, both the industry and the technology firms, the regulators, and yes, the consumer advocates, everybody at the table. Because I think that when you discuss the matters openly, then the result of that is wisdom born of experience and a desire not to repeat the past. So as I said, my agency is not just banking. We supervise the activities of banks, including many large foreign bank branches that are located in New York State, as well as non-depository institutions, which include premium finance companies, licensed lenders, check cashers, and also mortgage lenders and brokers, and insurance companies, which is a large part of the work of my agency as well, which are also obviously non-depository institutions, and yes, they all use technology. And so technology is not new. Certainly underwriting issues and use of data and aggregation of data are things that we're all talking about, and we're talking about them not only. Financial technology seems to be the word of choice on the banking side. InsurTech is the word of choice on the insurance side, but it's all really the use of technology to help with, data aggregation, underwriting, reaching of consumers. And in terms of the references to depository and non-depository and states versus federal. I say this all the time, blame Hamilton and Jefferson. They're the ones that created this wonderful mosaic of a country where we have federalism and we have states, and we have the states to fill the void in consumer protection when the federal government chooses not to do that. And really, when you're talking about in the banking field, when you're talking about non-depository institutions, it's actually been the states that have been the sole regulators from the beginning of time. Now the federal government is trying to get in this space, but in fact, the federal government has never been in this space of non-depository because banks, since Alexander Hamilton, he started the first bank in the United States, the Bank of New York, still exists as a state-chartered bank. It was about deposits. And that's also where, in 1863, when the National Bank Act came out, it was about deposits, and non-depository institutions, since the beginning of time, have been regulated solely by the states. And as you know, fintech, which, again, it's a great term, but it's important to discuss what it is and what it isn't. Fintech just means financial technology. No regulator, including me, regulates financial technology. There's not a regulator for that. Instead, there's activities that we regulate, and to the extent those activities utilize financial technology, then that's great. And certainly our banks do, and our insurance companies do, and our non-depository institutions use financial technology. I don't regulate blockchain either. I think it's great. I think there are certain things that we can put on the blockchain that actually further technology, and I'm not talking about cryptocurrency, I'm talking about other things as well. But there's nobody that's actually regulating that. It depends on what the activities are in terms of what is regulated and what is not, and for the protection of consumers. And so we in New York strive for a regulatory environment that promotes industry innovation. We're certainly strongly in favor of it. In fact, we've had a laboratory in New York since the beginning of time as well. Remember, New York is the financial capital of the world, the progressive capital of the nation. Somehow those things go hand in hand and have forever. Businesses thrive in New York and consumer protection is strong. And that's because of innovation for years. California as well is innovative, and certainly other states as well. But there's nothing inconsistent with promoting innovation and protecting consumers at the same time. And actually, virtual currency is a really good example of this. Virtual currency and people who are saying, well, we shouldn't have any regulation because we should just test this out. It's like, no. In 2013, my agency, actually before my arrival, had public hearings and looked at virtual currency and came out with a regulation of virtual currency. At the time, there was an exchange called Mt. Gox in Japan. and it had about 70% of the Bitcoin market. Bitcoin at that time was $100, which is really interesting. But it had lots of problems. And people got together and said, this is not a good thing. This is not a good thing for innovators. This is not a good thing for companies that actually want a strong environment and to have bad actors not in that environment. And regulation is one way to do that. So we actually recognized early on, and a lot of these businesses, Mt. Gox was one of them, and it ultimately failed and damaged a lot of people in doing them. They weren't complying with money laundering laws. They certainly didn't have any cybersecurity protections. And that wasn't a way to actually grow an evolving, innovative industry. So we at DFS came out with the Bitcoin license, and we set standards. Standards are a good thing. There's actually many companies that want these standards because they want to comply. They want to have good money laundering protections. They want to have good cybersecurity because they want to be best in class. And that's how a regulatory framework actually helps the good actors and it doesn't allow the bad actors to actually compete in an appropriate environment. And again, Mt. Gox was a great example in virtual currency, and I think history proves this in many other industries as well. And it's really important to stress that when used responsibly, fintech companies can provide services, can provide loans, can provide money transmission to hard-to-reach consumers. Of course, it's a great thing. It can enable an institution to underwrite transactions more quickly with the use of data. But what is that data? We need to be looking at what that data is. Is it discriminatory? Is it a proxy for something that we all agree is not appropriate in terms of an underwriting? And I think those are the things that everybody is talking about. And again, talking about it on the insurance side as well as on the banking side. I mean, this is not a topic that is new, but we can't allow regulatory arbitrage. I know that the panel just before me was criticizing what I have said before about a sandbox, but I didn't create that word sandbox. The people who created Brexit created that sandbox, by the way, so let's think about whether that's a good idea. But when you're talking about sandbox, right, what does it mean? Let's define what it means. And yes, it's where toddlers play. Adults play by the rules. Okay, parental supervision, I like that. We're moving closer. We're moving closer. There needs to be regulatory supervision. And yes, consumers should not be guinea pigs to test products. We need to look at all of these issues. We need to have capital standards. We need to have good underwriting. We need to have anti-money laundering protections. We need to have cybersecurity protections. We know what happened at Equifax because it had lax cybersecurity and consumer protections. Equifax is actually a prime example of what happens when an industry is not regulated and engages in financial services. Maybe one can say that Equifax was in a sandbox for way too long, but not anymore, and we don't want to repeat that. Turning to online lending specifically, as I said, we issued a report this last summer. We gathered information from 40-some-odd so-called marketplace lenders. We gathered information, we already had the information from our community bank, and we did a public, notice and gathered lots of information from others as well. I have to say I was troubled that not all of the companies responded to even our survey, even despite the fact we said, we're not going to say individually which companies did what, and we didn't in our report, but there were a number of companies that didn't even respond to the survey. I mean, that says something real concerning about companies that are not even willing to provide transparency of what they're doing. But in any event, as our report detailed, everybody knows this, online lending has grown in recent years. But the banking industry still supports the overwhelming majority of lending, certainly in New York, and they're subject to strong safeguards and oversight. We looked at specifically consumer loans and small business loans, which is the area of great concern to regulators, as it should be. Small businesses, consumers, individuals, small dollar loans, those are, you could say, more vulnerable populations that we need to look at more carefully. Same reason why our usury rates in New York don't apply to very, very large loans, because, we think that those are sophisticated people that can sort of decide on their own above $2 million. I mean, that's our law in New York. But when it comes to consumers and small businesses, we care a lot about that, and we want to make sure that whatever delivery channel is being used, and of course, financial technology is just a delivery channel for a product that here lending is subject to certain rules that we think are important. In fact, the mortgage crisis, I have to come back to that, it demonstrated the need for strong regulation. As I said, we regulate mortgage bankers, services, and brokers. And I think it's important to go back and see what happened there. Over a period of years, mortgage underwriting standards declined gradually. Lenders offered increasingly risky loans to borrowers. Automated loan approvals led to the no-doc loans led to an increased number of originations without any meaningful underwriting review. And most significantly, the originate-to-distribute model, originating loans that were securitized and sold to investors, minimized the incentives for those originators to properly underwrite those loans because the loans were not kept on the originator's balance sheet. I mean, that causes originators to take more risk. And of course, the access to capital of investment capital is much cheaper in an unregulated than in a bank. And so we know that. But the failure to underwrite those loans led to, properly led to a cascading series of failures, and we know what happened. And there are many Americans that are still suffering from the financial crisis. And we shouldn't then continue this with other type of lending, consumer, small business lending, student loans, all of this, where we're in a good economy now, but it hasn't been tested. And it didn't have to happen. The mortgage crisis didn't have to happen. And this is just a fact. There were attempts in 2005, 2006 to rein in some of this. There were attempts at greater regulatory oversight. And there were three critiques. First, it was argued that regulation would destroy these new innovative products. Innovation is always used as like, oh, we're going to destroy that. Second, argument was made that new underwriting models supported this additional access to credit. We're going to reach more people. And third, it was claimed that regulation will stifle the flow of credit to people who needed it most, or would deprive certain borrowers with low or no credit of choice of taking on a product that they could not afford to repay. I mean, that sounds eerily familiar today, and it's the same arguments today that I think we have to, in this dialogue, in this conversation, we need to remember those things. It may be that certain people should not get loans. It may be that we have to look very carefully at where those loans are going and how the debt collection is occurring and what predatory practices there might be. So whether you call it fintech or something else, when loans are made to consumers and small businesses that utilize untested standards, charge high interest rates. Yes, we don't like payday loans, and I don't like high interest loans. Maybe it's not a payday loan, maybe it's a 1-month loan or a 2-month loan. There's still things that a regulator looks at and says, whoa, is this something that can be paid back? And that's what we look at. Is ability to repay something that's part of the model? Because again, that was absent in some of the loans in the mortgage crisis that led to problems. And is it tested? And are we looking at this in the context of economic downturns? So yes, I believe that lenders of all stripes should follow the same rules. Whether you're a bank or a non-depository lender, you should follow the same rules. In fact, if you use financial technology, transparency and strict consumer disclosure should be easier. You should tell the consumer, this is exactly what you're getting, this is exactly what the annual interest rate is, this is exactly what the fees are, and at the end of the day, this is how much you're going to pay for that loan of this amount. And it should be fully disclosed. And it should be with oversight or parental supervision, however we want to call it. And I believe firmly that all lenders should comply with the Community Reinvestment Act. I know that we have some comments put out by the OCC, but certainly if you're engaged in lending and you're saying that you're actually serving the communities, then you should comply with the Community Reinvestment Act. Might there be some tweaks that are needed? How do you define assessment areas and things like that? But certainly I think all lenders should comply with the Community Reinvestment Act, because whether you're online or bricks and mortar, you're providing services to communities, or at least people and small businesses in communities. So we, of course, as state regulators, promote the state charter. And as has been mentioned, I strongly disagree with the OCC's so-called FinTech charter. A few weeks ago, I filed a lawsuit again against the OCC, challenging its decision to grant national bank charters to non-depository companies. As I said, and this is an issue that has its roots certainly in history. The federal government has never regulated non-depository companies. The states always have. And the National Bank Act, in our view and in our legal judgment, does not permit this OCC FinTech charter to exist. But there's some real practical and important policy implications here. First is the OCC FinTech charter would create an unlevel and unfair playing field to the detriment of our state community banking system. It would also create competitive advantages for the larger so-called FinTech firms that could overwhelm the smaller market players. That is not the way to promote startups or innovation. It just isn't. It's not going to be the small companies that are going to get that national charter, but they will be damaged by large companies being able to, and maybe be too big to fail, which is a whole different problem, but it's not a way to promote innovation and startup companies. The state system is the way, and always has been the way to do that. So we will continue to pursue that lawsuit, and I guess I say stay tuned for that, because we filed it a few weeks ago and we haven't yet received a response. But in the meantime, the states will continue to modernize and respond to innovation, as we always have. It is simply not true that it takes 40 plus, somebody said this, filings with the states. We work through the NMLS, which is the national licensing system of the states, that we work through that. Is it that there's compliance with different state laws? Yeah, sometimes, but that's the case with all businesses. Every business has to get a license to do business in each state if they're doing business in that state. That's the system. We're not changing that. And this is just another aspect of that, but we're working together to make it certainly more innovative and certainly more streamlined in terms of processes, and I am fully supportive of that. And I think it's important, again, to go back to history. And I know that some people don't want to hear this, but it's actually the states and not the federal government that have been the leaders in protecting consumers and in promoting innovation. Early on, and this has been through history, the federal government has tried to invade state authority. What's happening today is history once again. But in the face of that, states, and New York in particular, actually pioneered innovations. The insurance of paper currency, the so-called free chartering of banks. That was a precursor to deposit insurance, and the creation of central clearinghouses, which was really a function of state innovation. And in fact, in 1838, New York enacted its banking law. And by 1860, some 18 states enacted their own version of this free chartering or free banking, modeled on New York's law. New York also became the first state that licensed money transmitters back in 1964. So there's been innovation that the states have done, not the federal government didn't do any of those things. It's at the state level that these innovations occur. And I would say, because I like the phrase, New York has been a melting pot. It's been a melting pot for lots of different things, for innovation, for debate, for leadership and financial services. And don't let anyone say that the United States is being left behind. The United States will never be left behind, ever. And certainly the states, and certainly New York, would never allow New Yorkers to be left behind in terms of innovation, consumer protections, and the like. As I said, we're the financial capital of the world, and certainly the United States is, despite whatever might be going on in Washington at various points of time. We will never be left behind, and I think America is great and always has been. But anyway, we should continue the dialogue. And since no one else in Washington is sounding the alarm, then I will. If we're going to embrace new business models and new delivery of services, we must not repeat the mistakes of the past. We must not allow the irresponsible packaging of loans for investor profit while saddling consumers with high interest and fees. Strong regulation is critical, And it's the answer to providing that access to capital in an appropriate environment. So the philosopher George Santayana said, "Those who do not remember history are doomed to repeat it." Let's not do that. So I'll leave you with this. There's so much instability at the federal level. Opportunities at the state level to constructively engage are important to create a way forward that encourages growth while protecting consumers. It fosters innovation while maintaining a level playing field for all participants. I firmly believe that whatever new financial services technologies are on the horizon, the states will again be at the forefront of that innovation and the necessary regulation and consumer protections. I certainly look forward to continuing the conversation and the collaboration in this forum and in many others, and to continuing New York's leadership in both financial services and consumer protections. And it's 9 seconds. Thank you. Great to be here.